Hey everyone, welcome back to Corporate Decoder. Today we are diving headfirst into the financial filing of Saba Capital Income and Opportunities Fund. Let's decode this report and figure out what's really going on, hoping we don't need a financial parachute. Remember, we've got a Discord community to connect with other finance fanatics like you, so check the link in the description. Saba Capital Income Opportunities Fund just dropped a massive filing letting everyone know what's been going on with their money, where it's going, and all the risks involved. It reads like a financial roller coaster, complete with potential drops, gains, and loop deloffs. We're going to simplify it all so you can understand what the people actually care about, so you know what's going on. Let's dive into the financials fast because that's where the real story hides, and boy, there is a roller coaster here. For the period ended April 30 of 25, which is unaudited, they reported net investment income of just 22 cents per share. Remember now, it's important now, this compares dismally to 47 cents the year before. That's a big drop. To further emphasize the problem that they have, the financial performance includes the amount that came from the tax return, or lack of one. For the period ended April 30, which is unaudited, the tax return amounted to 0 for some auditee, no for, while not all is lost. But before you pull your investment out completely, the metrics might paint a better picture in the end. Total investment return based on NAV or net asset value stands at 7.1%. And the funny part is the investment return from market price is even higher at 9.26%. This discrepancy is something to keep in mind, as it would mean investments are actually doing pretty well, but at large are valued lower than what they realistically are. Moving on, even good investments can be wiped out by excess fees. The expenses, including waivers to average net assets, are 5.59%. This is a large percentage and shows how much the fund will need to make to generate good returns. Speaking of bad turns, we also see how much they borrowed. The aggregate principal amount of borrowings for this period ended April 30th, unaudited, is $45 million. While this sounds like a lot, it's significantly less than October 31's $86 million. This means they are making efforts to reduce debt to improve their overall returns. So if all this is what is happening with the money, how do they plan to improve these return stats in the future? Let's break it down with these stated fund goals and operations. The fund's main goal is high current income with a side dish of capital appreciation. To get there, they will be diving into debt, equity, and dipping into both public and private companies. Basically, nothing is off the table. They invest in both American and foreign stuff, and they don't limit themselves to investment grade stuff. They will go into the junk and high yield investments too. How do they do all this? They use leverage, which is a really fancy word for borrowing money to invest more, which can boost returns, but also amplify losses. They borrow from banks like TD Bank and use tricky things called derivatives, which is a really risky practice as well. It's like using a magnifying glass to start a controlled fire, or accidentally burning down the whole forest. Now, about those risks, every investment has them, and this one is packed. Closed-end structure, risk, market risk, and interest rate risk, and that is all without even getting to the interesting, unique things. If you think it's over there, it will not be. Their prospectus contains the section Risks a few pages later. A few examples will be listed below. Active management risk. The performance depends on the portfolio manager's ability to call the shots. If the managers mess up, the fund suffers. Sometimes it's better to be lucky than good. Since they make an effort to buy low-rated bonds that are typically high risk, there is also high-yield investments risk, which means there is a high chance of the borrower will not actually be available to pay them back, and sometimes the fund has to go through a significant process to get that money back if they can, which takes time. There is also inflation risk, which is that the purchasing power will be worth less in the future. No one is exempt. Illiquid investments risk is also listed. The fund could buy something that they can't turn around and sell quickly, taking them out of their position. It is very important to note that this doesn't appear to be the only occurrence, and that many securities are only known to be liquid because the advisor said so and are not publicly sold and traded. This means the fund could get stuck holding something and hoping to get paid back eventually. Speaking of illiquid, private funds are an area that the fund will utilize. What are the risks? The fund may rely on the performance of such funds underlying which the fund may not be able to fully evaluate. Transparency is the main objective here. Speaks anyone. Did you call for a scam? I mean SPAC. The key risk is they have a SPAC transaction happening. Shares will decline on value. The fund has limited to base if they are approaching target business, and in the end it may just not be that great. Investments in SPACs are speculative and involve a high degree of risk. So who is making these decisions? Saba Capital Management LP is managing the fund's portfolio. Alpes Fund Services covers accounting, administration, and acting as transfer agent, keeping track of shares, and Bank of New York Mellon protects the funds as the custodian. While there are a few, the main players here are, of course, key personnel. They are Boaz Weinstein and Paul Kazarian. To better illustrate how risky the above things can be, let's use a real-world example. As of March 31, 2024, their strategy for loans basically went sideways. They wanted to be in the right position for any possible increase. However, in the end, things drastically changed as interest rates suddenly dropped. This cost them 1.6 million. Yikes. Another important point involves the proxy voting and class action policy. The firm has the authority to vote proxies relating to such securities on behalf of the clients. The firm engages Broadridge Financial Solutions Inc. to vote all proxy ballots on behalf of the firm, using specific guidelines from Glass Lewis and Knapp Co. LLC. To explain it better, in simple terms, they vote for you when big votes are held, even when they might have conflicts of interest. So what is my take from all this? There are many notable points, but one sticks out. The company's filing says it follows this structure A2 qualified, which effectively is a filing to register additional securities from previous registration. It's great because it's basically the SEC's version of you are good, keep going. The main points are they need to fix what has been going on with their earnings. There is no good future. Is you have horrible present health with management being at the whims of economic factors. It may be better to focus on stability instead of highly leveraged investments. That's the decode on Saba Capital Income and Opportunities Fund. What do you think of their financials? Does the good outweigh the bad? I invite you to leave a comment below. If this analysis brought you value, hitting subscribe and sharing the video really helps. And don't forget to check out the Discord in the description where the discussion can really open up. Thanks for watching. See you next time.